I'm going to talk today about savings versus investing. What's the difference and what should you do first? Hey guys, what's up? Ron Parks here and welcome back to the channel. Saving and investing money can be a difficult task. Most salaries don't leave a lot of room for people to pay their bills, cover any emergencies, and then be able to dedicate a good chunk of cash towards their investment and retirement goals. But this doesn't have to stop you from saving and growing your money over time. Today we'll explore different ways to grow your money with as little as $10 a day or around $300 a month. Yes, it's possible, and I'm going to show you how to do it. When we think of savings and our financial goals, we tend to look at the big picture of, oh my goodness, more responsibilities. I'm going to have a family. I need to put my kids through college, and then I need to save for retirement. And then we think to ourselves, well, my goodness, that's a long way off. If I need to save over $1 million or more to retire, this can be very debilitating to think about. Recently, the Bureau of Labor Statistics released their report on the usual weekly earnings of wage and salary workers. Using information from the fourth quarter of 2019, the Bureau of Labor Statistics claims that in that quarter, the median income for a full-time wage or salary worker every week was around $936. So for a 40-hour work week, this translates to a yearly income of approximately $48,000, which happens to be an increase of about 4% over the prior year. You might ask yourself that if you're making the average American salary, how can you expect to invest and save for retirement or save just for an emergency fund? One can't help but wonder how I am supposed to get there if I can barely save enough to pay off my credit cards at the end of the month. Well, I don't blame you. Life is expensive, emergencies arrive often, and pay raises are difficult to come by. However, I'll show you today that a small change in your everyday strategy can make these financial goals possible. Investing and financial growth is a marathon, not a sprint. So the main thing I want you to know today is that you too can reach the place you want to go, one day and $1 at a time. When you see videos of people climbing Mount Everest, I know that I say to myself, well, I might as well be going to the moon. But since 1953, over 5,000 people have made it to the top. On the way, we've lost over 360 people. But those who tried and didn't make it because they had some bad luck and bad circumstances, they tried. So getting financially secure is much easier than climbing Mount Everest. So let's think of our financial journey as a skyscraper we want to build, one brick at a time. At first, the task will feel quite overwhelming and impossible, but we'll soon discover down our trip that the most critical steps are first to lay the cornerstone that will set its foundation, and second, the effort we make every day to lay down each brick very slowly and surely to build that skyscraper we want to one day retire on. Average retirement income in 2020 is somewhat driven by choices retirees made long ago. Where did they work? How much money did they make? How much did they save? Did they buy a house? Do they need to send their kids to college? And much more. However, retirement income is also driven by decisions retirees make today and trends driving the economy. So some of those trends are: one is decumulation. Traditionally, the concept of retirement planning has focused on saving. However, in retirement, you need to know how to spend your savings. With baby boomers retiring at record numbers, companies refocus efforts on helping retirees know how to turn their assets into income. If you're working with a financial advisor, make sure they focus on retirement as the end game. Now, some of the trends is also, well, what's the future of Social Security and Medicare? Social Security and Medicare are in real financial trouble. If you are of retirement age now, your benefits are probably not in peril. However, nothing's inevitable, and if you dive into the numbers, you can see that there are genuine concerns about the future of these programs that provide the lion's share of most people's retirement income. If you're in your 20s and 30s, don't count on Social Security. If it is still here, the age you can start using the money will probably increase above the current retirement age of 62. And pension plans, like Social Security and Medicare, many pension plans are underfunded. If you're lucky enough to have a pension plan from work, it may be worthwhile to investigate your plan's solvency. And where are interest rates going? While historically low, interest rates have been static or trending downward. Now, this is terrible news if you're trying to get guaranteed returns on savings. And then we move to stock market returns. After 10 plus years of a bull market, the market is still trending upward, but you can't count on this to continue. You have to expect ups and downs and be prepared to deal with it. Now, I'd like to get something out of the way so we can move ahead. Savings and investing are often used interchangeably, but there is a difference. Saving is setting aside the money you don't spend now. It is for emergencies or for a future purchase. Where investing is buying assets such as stocks, bonds, mutual funds, real estate, with the expectation that your investment will make money for you and grow. Now, we can all save money easily, but the real question is, how and when can we start investing our money? Now, before we begin, you have to answer these questions. Number one, do I have an adequate emergency fund? When choosing between saving or investing your money, first look at what cash you have to fall back on. Experts generally advise building short-term savings and then investing whatever surplus cash you have left over. For example, an FDIC insured savings account is nearly risk-free for short-term savings and is not subject to market fluctuations. And even though returns now are minimal, the purpose is not to grow the money, but to have it available immediately if you should need it for an emergency. And now, what classifies as an adequate emergency fund varies depending on your risk factors and how secure you feel your income is. But here are some of the guidelines. Put away 3 months of expenses if you're a couple with 2 incomes and very secure of your employment. Put away 6 months of expenses if you're a couple with 2 incomes, but one of you is less secure on your employment outlook. And put away 1 year of expenses for an individual with 1 income that is really not sure where the next year is going to go. Question 2, am I committed to leaving the money in place for 2 to 5 years or longer? For longer-term goals past the next 2 years, there are other factors to consider when deciding where to allocate your money. Savings accounts, even the best high-yielding ones, offer a relatively low return compared to investment accounts, and sometimes even lower than the rate of inflation. So if a savings account has a lower rate than inflation, the purchasing power of the cash in the account will decrease over time. This means that as inflation goes up, it will eat into an already low return. At this point, you should invest your money in low-risk investment portfolio. Investing the cash in a diversified portfolio will usually yield a higher average return than leaving it in a savings account. You should be prepared for some fluctuations in your balance and have an investment horizon greater than a couple of years. Placing cash in a well-diversified, low-cost investment portfolio will provide a greater likelihood of reaching your investment goals. A more aggressive approach comes with higher risk, but it's better for long-term goals when you already have the safety net of an emergency fund in place. Now, the answer to where to put your money is, well, asking yourself what kind of risk can you afford to take with your money. A standard option for beginners investing is putting money into an exchange-traded fund, commonly known as an ETF. ETFs are a collection of securities that typically track an index, the most common of which is the S&P 500. Now, ETFs don't require large amounts of capital to invest in, and you'll get a range of stocks when you invest in an ETF. They can be an excellent way to dip your toe into the investing pool and get exposure to the overall stock market. When you open an ETF, you can decide how aggressive or conservative you'd like to be based upon when you'll need the money. Fidelity, Vanguard, Charles Schwab, and TD Ameritrade have low-cost ETF options. Now, question 3. Can you weather the ups and downs of the market? This question addresses risk. If you think you'll need the money in the near term, less than 2 to 3 years, avoid investing it because of the additional risk you take on by putting your money in the market. Instead, use this cash to build up a savings that offers more security. The longer-term goals that allow you to take on more risk because you aren't relying on these funds so soon, then put that money in the market. Experts generally suggest that you can be aggressive with goals that are well into the future, beyond 10 years, and dial back the risk for goals in the near term. If you have a longer horizon, then you may be able to handle the volatility. What you want to avoid is having your money subject to risk when you need the money now. If you answered no to these 3 questions, then you need to focus on savings. And if you answered no to any of these questions, you're really not ready to start investing your cash. Saving is ultimately the first step to investing because you're not prepared to take on the risk of putting your money in the market. Now, here are some not so typical ways to grow your portfolio on $300 a month, which is about $10 a day. First, set up your savings emergency fund. Now, once that's done, you can look to invest and grow the rest of your assets. Okay, number 1. Automate the process. So what is the number 1 way to grow your money with $10 a day? Well, it's simple. It's finding a way to set aside that $10 a day, right? How are we supposed to even begin if we can't even find the $10? Now, wait a minute. Don't change the channel just yet. This is not another how to save $10 a day by not going to Starbucks video. I'm talking about setting up a system in place that will help you automate your savings and take the load out of your self-will. One of the most practical ways of doing this is by leveraging technology. For example, using an automated savings app such as Acorns, Chime, Stash, or Digit. Now, if you don't have to remember to put the $10 away every day, you have beat the first hurdle, which is procrastination. You can start with an investment account at one of the large mutual funds or brokerage companies. The best way is to open an IRA account and put that money away. It's tax deductible, and you won't have to pay any tax on the earnings until you start to withdraw the funds when you retire or reach 70 and a half. Now, number 2, stick to an investment plan. A stock market dip can be a good buying opportunity for steady investors who want to add to their portfolio. Intuitively, you want to run away. But what you should be doing is continuing your strategy of buying a mix of stocks and bonds. Review your investment strategy once or twice a year, and don't let headlines throw you off track as you allocate these funds. The goal should be for it to be an ongoing process, not to be stopped or restarted because of the news of the day. Okay, number 3, buy fractional shares. In our previous video on how to build wealth in your teens, I'll leave a link below. We talked about a force that Albert Einstein described as the world's 8th wonder. If you haven't seen our last video yet, be sure to check it out. Einstein refers to the force of compound interest, and one of the tools we can leverage to turn our small gains into significant victories. Compounding requires the purchase of interest and income-bearing assets, and the reinvestment of those profits back into the account. This effect causes a parabolic yield curve over time, and it's the tangible proof that a paced marathon will get you much further than running a sprint. A great way to take advantage of compound interest with only $10 a day is by purchasing fractional shares. Fractional shares are just like regular shares of a company. They pay the same dividends, they grow the same way, and they yield the same results. However, to make them more accessible to investors, notably in names such as Amazon, Shopify, or Google, which can run in the thousands of dollars per share, brokers now offer an opportunity to buy a fraction of one share. Fractional shares are a great way to invest your money daily, especially on smaller amounts like $10, because it lets you place that money into the market right away. Just think about it. If you wanted to invest in an Amazon share and had to save thousands of dollars just to buy one share, how long will it take you? And how discouraged will you get before you even get there? Now, many retail brokers offer fractional shares, such as Charles Schwab and Fidelity. You can just Google it and you'll find a lot of opportunities. Now, number 4, another way to save $10 a day towards your retirement is crowd investing. The new era of technology has facilitated investing and made capitalism available to more people than ever before. In the old days, only those who were wealthy or had access to some of the most lucrative investment opportunities, such as the purchase of real estate and the issuance of personal loans, were the ones who moved ahead. So just think about this. While credit cards carry a high risk, the reward that banks get from them is 5 to 15 times that of what they have to pay for the use of the funds. So while the average credit card charges between 14 and 28% annual interest rates, the actual cost of the borrowing from those checking accounts and money markets on deposit won't pay more than 1 to 2%. So there's a big gap between these two. Now, previously only available for big banks and institutions, but no more. With the invention of new technologies and the accessibility of the internet, a new trend is emerging, opening the gates to large investments for small accounts. Crowdfunding is a way of gathering small investment contributions from many people to fund a larger investment. Crowdfunding options range from funding to buy real estate and income-producing properties such as multifamilies, funding to make loans so you can get interest on them, funding to invest in works of art, and much more. They make a great way of investing small amounts of cash into lucrative investment opportunities. And one of my favorite crowdfunding resources is the Lending Club. Here you can invest in loans with amounts as little as $25 a loan. My favorite strategy is to search for requests from people that have good to excellent credit scores and that have low credit usage and that intend to pay back the loan within a short period of time. Short-term loans reduce the borrower's risk of losing their income source or any other major life emergency that could arise in a long time frame. When I invest the minimum amount on each loan to minimize my overall risk while I'm still able to generate a better result than I would by investing in other less risky means. As you can see, my strategy is mostly balanced between low risk, high yield return. I employ this strategy because I am well aware of the marathon versus the sprint ideology we discussed earlier, and the real impact it has over time. Of course, like any investment, they do carry a degree of risk, which could incur a loss of capital. I would like to remind all of my viewers that these are not buy or sell recommendations for any financial asset, and this information is provided for your educational purposes. You should always seek the advice of a professional advisor before investing into any class of assets. And now, a fifth way of investing your money and doing it well is getting a financial advisor to help you. The tangible benefits of working with a financial advisor gives you one, clarity. The goal of the financial planning process is for advisors to understand what their clients hope to achieve, what are their current goals, priorities in their life, and how can they help achieve them. With that in mind, the advisor helps bring clarity to the client situation through this process. And more often than not, I'd say that clients of financial advisors, they rarely talk about money outside of the confines of the relationship with their advisor. Well, at least before working with the advisor. Now, without talking openly about your finances, how can you clarify which actions need to be taken to make progress towards savings, debt payoff, or investment goals? Having a place to discuss finances without judgment openly provides clients clarity about the path forward. And financial advisors also will give you a sense of accountability. What good is a financial plan full of action items if you don't do what's recommended and don't implement it? Well, the answer is no good. It's easy to get caught up in the hustle and bustle of everyday life, especially when you're balancing a career, marriage, kids, and hopefully some time for hobbies. An advisor should be there to hold you accountable to the plan that's ultimately developed to ensure you're making continued progress. Whether it's personal finances and your advisor, your career and your mentor, or life and your spouse, having an accountability partner to keep pushing forward and provide support is a priceless benefit. And financial advisors also help you with learning. Learning about personal finances and investing is part of the process of working with a financial advisor. Part of the reason I write and do these videos is to spread personal financial education. I also make educating a crucial part of my process. By learning more about why a financial advisor is making a specific recommendation, clients can gain confidence in their own finances. A sense of confidence can help relieve stress or confusion surrounding their financial future. For example, By automating most personal finances, people know they're making progress towards their specific goals. It's not something they have to think about on a daily, weekly, or monthly basis. Their cash flow is automated to be allocated to their children's college education funds, 401ks, IRAs, and other high-yielding savings accounts for their emergency funds. So learning about personal finances along the way helps build confidence in your future. And the last thing, you get a lot of peace of mind. The last intangible benefit of working with a financial advisor is peace of mind. While the previous three all play into achieving peace of mind with personal finances, the end goal as a financial advisor is to help clients achieve this peace of mind. This is developed through trust, learning, accountability, clarity, and the technical aspects of financial planning and investment management. An advisor helps tie into a completed financial plan for their clients. And over time, having peace of mind around your finances is the ultimate goal. Knowing that you're making progress towards paying off debt, investing enough for financial independence, saving enough for your child's college expenses, and still having funds available to enjoy your life today is a fantastic achievement. Having peace of mind enables you to enjoy life without stressing whether you're making progress towards your financial goals. So to summarize it all, if you want to grow your money with the long term in mind, you need to consider this. Number 1, automate your savings and investments. Number 2, stick to an investment plan and keep it going. Number 3, invest in fractional shares for compound interest gains. Number 4, leverage the power of crowdfunding. And number 5, get a financial advisor as soon as you think it will be helpful. Now, if there are any topics that you would like to know more about, or if you have any questions, please leave a comment below. I enjoy hearing your feedback and learning more about which topics you want most, where you are getting the most value out of my channel. And helping others grow financially is my passion, and I hope to help you and provide as much value as possible with my content. So if you liked today's video and would like to see more, please don't forget to smash the subscribe button for the YouTube algorithm, like this video, and ring the bell so that YouTube keeps you informed and up to date with all of my content. And I hope to see you all next time. And until then, thanks.